Greetings, class. Dr. Royer here, and this is Chapter 16. In this chapter, I'm going to talk to you about short-term financial planning, and then I'll move on to Chapter 17. In Chapter 16, I want to talk about the things that are really going to matter the most that you are doing on your homework. Now, for those of you who may have calculated the homework and may need to revise it, let me know, and I will see. If you contact me, I'll give you some extra time if you look at this and you feel like you need to make a few changes to the chapter problems in Section 5. And anyway, here's what we have. We have short-term planning, and when we talk about short-term planning, one of the first things you're going to need to know about is how to trace cash and net working capital. They talk about this in the chapter quite a bit, and you're going to need to be able to do this because you have some problems that you're thinking about where you're looking at the operating cycle. So in the book, they go through a series of formulas and show you how they get to the place where they can calculate cash based on these elements in the financial statements. Then they move on and they talk about these activities that will increase cash. This is important because this is going to be in your homework. There's some of this in your homework where they ask questions about this. But also, if you're in accounting, these kinds of things you'll need to know when you work on a statement of cash flows. These things are going to come into play when you do a statement of cash flows. So the actual events in these lists are exactly the opposite of one another. So whatever causes an increase in cash, if it happens the other way, it causes a decrease. Now, what we're looking at here is there are two cycles, the operating cycle and the cash cycle. An operating cycle basically is going to be the time that it takes a business to acquire inventory, pay for the inventory, and then sell it and collect cash. So you can see the steps here in this short list. It's taking this company 105 days to go from the time that they acquire the inventory before they actually collect it in cash. That's called the operating cycle. And inside that operating cycle, there are a couple of things that make it up. One is the inventory period. This is the period of time it takes for you to get the inventory and sell the inventory. So from the time you get it to the time you sell it, it's 60 days. And then the accounts receivable period is the time it takes from when you sell the inventory on credit to collect the cash. So you'll see here the operating cycle, and the two components of it are the inventory period and accounts receivable period. Then we want to talk about what the cash cycle is. So the cash cycle is part of that. It's not that, but it comes into play with that. So when we're talking about the cash cycle, we're going to look at, we have to figure out what time we need to arrange the financing for a period between the time when we expect to collect the cash and when we have to pay for the receivables. So in this case, what we're looking at is that we actually pay for the payables. So in this cycle, what we actually have to do is we pay for the inventory before we can sell it and before we collect cash. So that means we need to have some kind of financing. So what we do is we take the days it takes to bring everything to pass, to collect the cash from getting the inventory to selling everything and to getting cash, 105 days, minus the 30 days that we have to pay for the inventory. That means we have 75 days that we need to cover with cash. That period is called the cash cycle. So in other words, we're going to have to go for 75 days based on or with some kind of internal reserve or some kind of cash availability until we collect the money from our customers. So the cash cycle is equal to the operating cycle minus the accounts payable period. You can see that very well here in this chart, in this timeline. Time comes where you get the inventory and you sell it, but you notice you have to pay for it before you sell it. So the time that you need cash to cover that is going to be this 75-day period between the time you pay for the inventory and the time you collect the cash in-house. So there's a lot of folks here that give you roles and what they do typically in a business and how they interact with the cash cycle and operating cycle, and that's good information. But there are some ratios, and we've talked about these some, but these have a lot of good information in them when it comes to figuring out the operating cycle. And this one is the inventory turnover. We're interested in inventory turnover because we want to know how many times during the year we're going to sell our inventory. So in this case, we take cost of goods sold for the year divided by average inventory for the year, and we get 3.28 times. So if we take 365 days in a year divided by that 3.28 times, that means we sell it 3.28 times in a year. We get that it takes us 111.3 days on average to sell our inventory. Receivables turnover is the same, well, not the same, but it's similar in that we take credit sales divided by the average balance in our accounts receivables account, and we figure out how many times a year, and these are credit sales for the year and the average balances for the year, and we say, okay, when we do that, we collect our accounts receivable 6.4 times a year. If we want to figure out how long that is, we take 365 divided by that turnover rate, and we get 57 days. In other words, it takes 57 days to collect our receivables. So the operating cycle in this business is inventory period of 111 days plus the accounts receivable period of 57 days, or 168 days. That's how long it takes to go from ordering, acquiring our inventory, selling our inventory, and collecting cash. So now we look at the cash cycle in a similar way. We're going to take the cost of goods sold divided by the average payables, and that'll give us a payables turnover. So for this calculation, we get 9.4 times a year. We take 365 and divide it by the payables turnover, and we get 39 days in a year. That means we actually pay our payables every 39 days on average for the year. So now we take the operating cycle of 168 days minus the payable period of 39 days to get the cash cycle of 129 days. So what we're saying is there's actually a 129-day delay from the time we pay for the merchandise to the time we collect on the sale. They go through some calculations here in an example you can look at and see if you understand this. And then they talk more about this here, about the different receivables periods and inventory periods and operating cycles that are in these different industries, and you might look at that with some interest. The industries are going to have some things that shouldn't be too surprising. So if you're looking at multi-line retail, it shouldn't be too surprising that their inventory period is relatively short, and so is their operating cycle, and the cash cycle is fairly short as well. That shouldn't really be too surprising. And it is surprising a little bit that the auto components have such a short cash cycle. Now they may they may attribute that now to just-in-time inventory, which I think probably has a big influence on that. And then they give you some specific companies to look at here and kind of analyze. But really for this chapter, what we really need to look at and think about, they talk about short-term financial policy here. This is good information, and I would advise you look at it. But when you're talking about the homework you need to do this week, it's not going to really have huge impact on the chapter problems. What you're going to have to do here, what you need to think about here, when they talk about financial policy, what they're talking about is a flexible policy versus an inflexible policy, where you have some flexibility because you don't have a high level of short-term debt. So basically what you're talking about, a flexible policy means they have a fairly large investment in short-term assets or current assets, and it would be financed with relatively less in short-term debt. So the other kind of policy, the more rigid kind of inflexible policy, would require that a company have more debt. And basically what that is that's a result of the acquisition of debt. So if you're interested in that, you can look at it. But for the homework, I want to point out a couple of things here that you need to be aware of. Probably one of the more important things in this chapter is this idea of collecting cash and identifying cash flows, so like a cash budget. When we talk about cash budget, what we're looking at is the cash we collect, the cash we spend. So as a business, what we want to do is we want to look at some things and determine how our cash flow is going to look. And we may not know exactly, but we can calculate it. Based on past trends, we're going to say our cash collections are equal to the beginning accounts receivable plus about 1/2 of our sales for that month or that quarter. So here you see they have beginning receivables, and they have sales for that quarter of 200, and then you have cash collections, which you're going to figure is this 120 plus 1/2 of the 200, that's 220. The ending receivables then are actually going to be carried over to the quarter 2. You're going to have beginning receivables of 120 plus 200, which is 320, minus 220, so you get 100. So you're going to do that for every quarter. And what you're really looking at here are cash collections. You want to budget the cash collections. You want to figure out what you're going to have coming in cash. Then you have to look at the cash outflows. So how do I look at that? Well, if we're paying accounts payable, wages, taxes, and other expenses, anything else that we have. So here's what they're going to show you. In the cash disbursements for Fun Toys, the one we were just looking at, they're going to show, well, this is how much we're paying of accounts. So we have 120. We have wages, taxes, and other expenses. We have long-term financing. So our total cash disbursements are going to be 180 in quarter 1. Quarter 2's 360, quarter 3's 220, quarter 4's 340. So basically what you're going to do then is you're going to look at the cash collections versus the cash disbursements to figure out what the net cash flow is. In this case, it's a positive cash flow in quarter 1. Quarter 2, it's negative. Quarter 3, it's positive. In quarter 2, it's negative again, although considerably less than the negative in quarter 2. So, and by the way, these figures are in millions, so you're not going to, this is going to be a very big impact on the business. But again, you're going to take the beginning cash balance that you have, and you're going to add the cash inflows, and you get an ending cash balance, and you're going to have a minimum cash balance that you want to keep on hand in the business. And so then you say you have a cumulative surplus or deficit. You carry that forward, well, you carry the ending cash balance forward, show the net cash inflow, and you immediately have a deficit here. You have a minimum cash balance, and you have multiplied that, well, you've increased that deficit to 60 million here, but you're going to carry this deficit of 50 over here to quarter 3. We then have the deficit. We're going to have net cash inflow of 55, so we have an ending cash balance of 5 million. We take out the minimum cash balance, and we're short for the surplus by 5 million. Then we move forward into quarter 4 with carrying this ending cash balance forward. We take out the net cash inflow, which is outflow in this case, a negative. We have an ending cash balance of a negative 10 million. We have a minimum cash balance of 10 million. We subtract that from the negative, we get a larger deficit of 20 million. So what you're really doing here is you're taking the cash inflows and outflows to figure out where your cash is going to be for this business. Okay, so that's the cash flow, and it's like a cash budget problem. Then you also deal with things like a short-term borrowing. You may have a line of credit arrangement where you can borrow to a specified amount. Committed lines of credit are more formal legal arrangements and involve a commitment fee paid to the bank, and it usually is a floating interest fee. Accounts receivable financing, you can actually take receivables and assign them and receive payment for them or factor them. Under an assignment, what you're doing is you're borrowing money on your receivables, and the lender that you're getting the money from has the receivables as security. But you, who are borrowing the money, are still responsible if a receivable can't be collected. With conventional factoring, basically you're going to have a receivable that you have on the books. You're going to send it out. It's going to be discounted, and it's sold to the lender. You're not actually retaining it. Once it's sold, collecting the receivable is no longer the borrower's problem, but the factor's problem. And the person who is the factor, or the business who is the factor, assumes all the risk when they get into that business. Now, there are some companies that do factoring, and that would be similar to, well, it'd be like a discount on any kind of payment that you're going to get in the future. They're going to look at it and see what the risk is, evaluate it, and discount it based on those factors. Inventory loans are short-term loans to purchase inventory. Usually what you're dealing with here is some kind of a blanket inventory lien in some cases, where they have a lien on all inventory. You may have a trust receipt. The borrower can hold specific inventory in trust for the lender. This is what they call something what they call a floor plan for auto dealers. What they do is they basically have an inventory, but they're holding it in trust, and it's a secured financing. Basically, it's tied to specific items on the showroom floor, but in this case, they're specifically identifiable items, so it's relatively easy to use, because as the dealer sells an automobile, they can very quickly identify it and pay that portion of the financing for that trust receipt off. For other kinds of items, it's much more difficult to do something like that. You could not, for example, do this with a crop, because it's not identifiable like an automobile is. Field warehouse financing basically acts as a control agent to supervise the inventory for the lender. So a public warehouse company is going to oversee the inventory in the warehouse. There are other ways to borrow. Commercial paper is one, and there are many others. But let's go ahead and move on to the short-term financial plan. This is where you're going to put all this together. You're going to say, okay, we're looking at the cash that's coming in. We're going to say, here's the beginning cash balance. Here's the net inflow. Here's the ending cash balance. Here's what we want on hand. Here's our cumulative surplus or deficit, and our ending short-term debt. You didn't have to borrow anything that month. So you carry forward the ending cash balance. You go through the same cycle, but in quarter two, you're going to have to increase your short-term debt to cover the deficit that you have here, or the deficit you have here, this $110 million deficit. So what you do is you borrow $60 million, and then in quarter three, you carry the cash balance that you're keeping, which is the minimum, $10 million, forward, have new cash inflows. Then you're going to pay some cash outflows here on short-term borrowing, and you're going to repay some of the short-term debt, and you'll have an ending cash balance, and you'll have the minimum that you need, which leaves you with zero. And so you have beginning short-term borrowing minus the change in short-term debt, which is what you paid here, and then you have this $8 million in short-term debt. You bring the $10 million cash balance forward and show the negative cash inflow. You have interest on short-term borrowing. You're not going to repay any of it this time because you have a negative cash flow. You get an ending cash balance minus the required minimum, and you're at zero. You don't have that required minimum. Well, you do, I'm sorry. And then you're going to take the carry forward ending short-term debt here, but in order to actually arrive at that minimum, you're going to have to put in another 15.4 because they show that right here. Since you had a negative 15.0 million in cash flow, you're going to have to cover that with short-term debt. So what you wind up with here in quarter 4 is 23.4 million in short-term debt. That's going to be a little bit, that's going to be what you're going to do, what you'll need to do with the homework. So the homework here is problem 1, 3, and 5. In problem 1, you're going to look at changes in cash account and identify what changes happen. 3, you need to identify changes in the cash in the operating cycle. What does this do to it? And number 5, you need to calculate cash collections, just like in that cash budget we mentioned up above. All right, that's chapter 16. I'll be back with 17 very shortly.